In this video, we're going to talk about bonds payable. This topic can be a challenging one to read about, so let's try to look at it visually. For the sake of example, let's pick two corporations, Company A and Company B. And so Company B is going to end up giving something to Company A, and of course, Company A has to give something in return. Let's take a look at Company A. In a typical bond transaction, one of the companies is going to receive some cash up front, a large lump sum payment. So here, Company A gets a lump sum amount from Company B. Going over to Company B. Company B is also going to get payments, but they're a little more complicated. Company B gets periodic interest and a one-time lump sum from Company A. Taking a look at the bigger picture, we can draw a timeline to see when these cash flows occur. So we'll use some larger lines to indicate a year, and this would be year 1. And we'll put a little line in the middle to indicate the 6-month or semi-annual mark. We'll do the same for year 2, year 3, and year 4. Now remember from earlier how Company A gets a lump sum amount from Company B? Well, that would occur right at the very beginning, essentially when time is equal to 0. Also recall that Company B gets periodic interest and a one-time lump sum from Company A. So the interest would occur at each semi-annual period if this was a semi-annual bond. So we'll use red to represent a payment from Company A to B. And this would occur at every semi-annual period over the life of the bond. And then at the very end, there would be a lump sum payment as well. Now all of the terms and conditions in this fact pattern gets wrapped into a contract. And this contract is what we call a bond. A bond is a formal contract between the issuer and bondholder. In our example, Company A would be the issuer and the bondholder would be Company B. Now the terms in the bond contract are important to understand. Let's go through the main ones. The first is known as maturity value. And the maturity value is the lump sum amount that the issuer must pay the bondholder at the end. It's also referred to as the principal value, the par value, or the face value. The maturity date is the next term we should understand, and this is the date that the lump sum amount is due. In other words, this is the date that the maturity value is due from the issuer to the bondholder. Next, we can talk about the interest rate, and that is the annual rate of interest the issuer must pay the bondholder. Remember that this rate will always be expressed annually. It's also called the coupon rate or the stated rate of interest. And finally, we have the interest payment frequency. So in our course and most introductory accounting courses, it's usually a semi-annual period or once every 6 months. Now that might seem like a short video, but there's actually a lot of content there. It might be worthwhile to go through this material multiple times before you look at the subsequent videos where we go through detailed numerical examples. So until then, thanks for watching, and I'll see you next time.